It's been a tradition, at least recently with the Advanced Crop Advisor Workshop, that we provide a session, and typically it's been a general session, giving a look at our current state of ag economics. And we feel that it'd be useful for you as crop advisors as you work with your clients during the balance of the winter, just to have that perspective on a market outlook and general financial status of our growers. And so with us today are two gentlemen. They've actually been with us in the past, and we're pleased that they joined us again. And so I'm going to introduce both of them, and then I'll allow them to just get right into their presentation. I'm going to introduce the speakers. The first speaker is Tjosaas, and he's with the Farm Business Management out of the Northland Community and Technical College in Moorhead. He has a Bachelor of Science degree in Ag Ed from the University of Minnesota in Twin Cities. And so he works with quite a large number of farmers in the Red River Valley, primarily in Clay, Wilkin, and Norman counties. And he works with them to analyze their finances from their farm and give them some tools to make decisions regarding the future of their farm finances. And then in addition, he also coordinates a marketing class for a group of farmers to discuss current market trends and discuss strategies for marketing their crops. So thank you for joining us this morning, Josh. Our second speaker is Randy Zimmerman. Randy is a grain merchandiser from West Central Ag Services out of Ulen. In addition to that work, Randy also finds time to farm, and he farms near Ulen, raising corn, soybean, and wheat. Previously, he served as a farm management instructor for many years and also a high school ag instructor. He was originally from Ulen. He has a Bachelor of Science degree in Ag Ed from NDSU, and his primary responsibilities for his job as grain merchandiser are to buy grain, of course, for West Central Ag Services. And then he also runs a number of marketing groups to help producers stay informed on the current market situation and then potential strategies for marketing their grain. So thank you, Randy, for joining us as well. So with that, I'm going to turn the program over to Josh, and we'll look forward to your presentations.
Thanks, Greg. Appreciate that introduction. We're going to kind of get right into the presentation here, just because we want to cover a lot of information and want to make sure everybody can see what we have in front. So I'm going to talk a little bit about 2020 kind of farm profitability and compare that to the 2019 year, and then do kind of a quick outlook on what 2021, or discuss a quick outlook on 2021. So we're going to talk real quickly comparing 2019 farm profitability to 2020 information. The 2019 data is taken from the Red River Valley database, which includes all farms that submit data both on the North Dakota and Minnesota side, all the way down from kind of the Wahpeton, Breckenridge area, all the way up to the Canadian border. The 2020 data, because we haven't finalized that Red River Valley book yet, is actually coming from my Moorhead Farm Business Management students, and right now I have about 35 students that have completed an analysis. So there's about 130 plus or 200 plus in the Red River Valley database, and you'll see why there's some differences when we get there. Greg kind of alluded to my farms then fit into that location of anywhere kind of just south of Breckenridge, Minnesota to north of Halstead, Minnesota. And the average acre farm at this point that's in the data, my smallest farm is about 250 acres. My largest farm is just over 11,000 acres. And the age range is anybody from beginning farmers in the age of 20 to my oldest farmer in the data is 78 years old. So 2020, of course, is a significantly change from 2019. A lot of you are aware of this. You know, we had a better harvest. There was a significant amount of government payments that came in 2020. A lot of those were attributed to the 2019 crop. And then, of course, we saw increasing crop prices, although that doesn't necessarily reflect fully in the 2020 year because a lot of that grain was marketed or sold ahead of time. So we may see that trickling into the 2021 year or the prices increased after they got it marketed, or if they did some, their January 1 prices would have changed even after January 1. So in 2019, the average farm in the Red River Valley actually lost $42 per acre of working capital. Working capital is a quick calculation of their total current assets minus their total current liabilities. while in 2020, my group of 35 farms are actually showing a gain of $54 per acre in that same time frame. So almost $100 per acre swing in working capital from 2019 to 2020. So 2020 definitely healed a lot of balance sheets, got a lot of balance sheets back into what I would call a comfortable situation. Obviously not a great situation for some, but definitely a lot easier doing cash flows in 2021 based on where their balance sheets ended the year at. So 2021 looks to be more promising due to the current and expected crop prices for 2021. And obviously Randy's going to talk a little bit more about that. On the whole farm side, net farm income is almost exactly double from 53,000 to 106,000. Current ratio is a little bit less. Now, some of that is we have farms that had good current ratio, even though their net farm income was lost. They lost some of that current ratio. And again, we have to take into account that this is a smaller percentage of those farms. I fully expect that the current ratio will be higher when we get all the Red River Valley farms in there. And you can see the difference, the working capital side versus the working capital here. Again, when we're dealing with my group, maybe have a little bit smaller acreage across the board. You know, they still had a good net farm income year, but their working capital is still relatively tight, especially when we consider that as part of gross revenues. I did have a lot of younger farms that actually took on more debt in 2020. They bought land, they bought machinery as opportunities for them. So again, farm debt to asset did increase a little bit for my farms because of that. But the one thing that's really significant is this term debt coverage ratio. Most banks or lending institutions like to see a 1.25 or stronger, and we can see that we're almost a 2.0, and that's the ability for the farm to pay all their debt obligations after they've paid all their farm operating expenses, paid their personal family living costs, and they've paid their personal income taxes as well. So this is the amount of money that's available. So basically they almost have $2 for every dollar of term debt that they have to pay, which is considered very strong. And then operating expense ratio, again, about 10% less than it was a year ago. And that's if we take a $100 bill and say, for every $100 that came into the farm of income, where did that go? This is saying $72.30 went to running the farm. There's three other ratios that add up to that $100 bill, and that would be interest ratio, it'd be depreciation, and net farm income. You know, so if we can get this down in that 70%, that leaves at least 30% left to pay interest on operating term debt coverage costs, depreciation, which is our proxy for principal, and then the rest is that net farm income that goes back that has to be used to pay for family living. So that's kind of a key metric we look at as well. So the average size farm, you can see a little bit smaller in my group as of this point. Average acres owned is a little bit less at this point. Machinery cost per acre is a little bit higher. Again, when you have less acres but similar machinery, you get a little bit higher machinery investment cost. So that's the amount of machinery that they have divided by the number of crop acres. It's not their machinery cost per acre, which is a different calculation that involves things like fuel, repairs, machinery depreciation. Average age of operators is just under 50 years old. Family living, you can see, is very comparable to a year ago at $76,000. And the non-farm income off of the farm to help offset that family living or help with the farm is about $18,000. What you're probably more interested in is on the crop side. Some quick numbers. You know, you can see corn yield actually from our farms is about almost equal to what it was a year ago. The difference is we were about 50, almost 60 cents higher on yield. On the price received, and of course the gross returns is about $80 higher. So included in that is about $40 worth of dividend income from farmers, and the CFAP 2 payments that they received kind of in October through December, depending on when they filled that out. That's part of that gross return. And then we also have a return with government payments, which would be like our county PLC payments would be a different number that's a little bit lower. But including this gross return is part of that. Direct expenses a little bit cheaper on seed, fertilizer, chemical, overhead expenses. So here's our slide. Sorry. The total direct and overhead costs almost identical to a year ago, about $600 to $594. The net return per acre is probably the one that stands out the most, is that we're about $100 higher on corn on rented ground. And then after labor and management, which is our proxy for family living, you know, you can see it's about that $100 swing. So a lot more profitability in corn this year. Cost of production before we add in government payments was $3.61. Obviously, when they sell it for 37 cents higher per bushel, that's where we're seeing that profitability. On soybeans, we actually, in our area, we actually had a decrease in soybean yield, and some of you that worked in that area are familiar with that. But we had about a 70-cent increase in the sale price currently. Our gross return was about 50 cents less because of that less yield. We do have about $18 that is tied to that CFAP2 and dividend money. Direct expenses almost identical to a year ago. Overhead expenses almost identical, and you can see that total direct and overhead is within $2 of that. Net return is a $50 swing. We actually have a negative net return on soybeans. And then after labor management and including government payments, we actually saw where we actually only had a $3 decrease. So government payments help, but when you put in family living, we still lost $27 per acre. You can see the cost production before we put in government payments or labor management was $11.45 on the 31 bushel soybeans. On wheat, and again, most of my farms are in the southern part of the valley, so obviously we'll see a little bit higher number as we go further north. But you can see we're about 2 bushels less on yield, but we're about 50 cents higher on gross value. So that's the value that they actually physically sold the 2020 crop for. Or if they hadn't priced it by January 1 of 2021, then it's the price that was set as December 31st ending values for that. Gross return was down about $50. Direct expenses up about $10. Overhead was down about 10, so our total direct and overhead was within $1 or so of what it was a year ago. You can see last year the net return per acre lost just under $1, and then after labor management lost $27. This year we're at about almost a $50 bill on a loss on spring wheat. You know, and you can see our cost production before labor management is about $7. Sugar beets, just for those of you that work with some sugar beet growers, this is on rented ground. All these crops were rented ground, but on owned stock. So in 2020, we actually saw an increase in yield, and we realized the hardship that 2020 was for those producers. So about a 26-ton crop versus a 16, 17-ton crop a year ago. Value per, it says per bushel, but per ton would be $36, almost $37. This is the blended average of some Mindac growers and primarily crystal growers. A lot of my growers in the southern part here actually had, some lower quality sugar, had decent tons. So that's a reflective in the actual price. That's their net tons after retain number. And then gross returns was just under $1,000. Direct expenses almost identical to a year ago. Overhead was a little bit less. Again, last year with those that did actually get crops harvested had a lot significantly higher expenses. They also had some expenses last year tied to liquidated damages for those that didn't harvest crops, but did have data that got put in there. That's part of this as well. Total direct and overhead is very typical to that $1,000 per acre. So last year there was an average loss of $238 to $330 with labor management. This year, right now, they're losing about $31 per acre, and with labor management losing about $122. And the cost production you can see is significantly different at $38 a ton versus $64 a ton. One of the things that's not added in here is we talked about government payments earlier. Is in 2019 they didn't receive it until 2020. There was WIP plus payments that came through the cooperatives, both through Mindac and American Crystal. That did lower this net return that came in this year. That's part of the profitability for this year, but really would have helped the profitability on those specific crops, especially on sugar beets. Obviously, there's some WIP money that's tied to corn and tied to wheat and tied to soybeans from 2019 for most counties as well. But this will be a significant number. On most farms, it was a $200 to $300 per acre difference. So it would have made last year kind of a break-even type year. For more information, I just want to highlight real quick the Finbin database. If you do a Google search with Finbin, you will actually come up to this page and you can select, if you want to select Minnesota and North Dakota, you just want to select North Dakota. And then you can select by county if you want to. You can select by crop. You can select by owned and rented. If it gets below about 10 data sets, usually you're not going to get enough data, so you might have to expand to surrounding counties. But you get a good idea. You can get a lot of the same information we have. The 2019 data is included already. But the 2020 data we're still working on. We'll finalize that here at the beginning of March. And by the first part of April, the 2020 data for both North Dakota and Minnesota will be uploaded into the Finbin database. And it's something, if you want to go back historically and look at those kind of costs, these are actual costs coming from producers, from their information, from their records. So it's something that, has been done for, decades. It's a good, valuable resource. The last thing I just want to highlight real quick, and that'll lead into Randy's presentation, is we do have our crops that we kind of share with, looking at projections. This is as of last night, the closing costs at about 2 o'clock, or closing prices on wheat, soybeans, and corn. So on wheat, we're basically, they can market for on average about $6.22 a bushel, $11.31 on beans, and $4 corn, assuming a 55-cent, a 60-cent, and a 30-cent basis levels. And you can see kind of here, wheat is in this scenario with $140 cash rent is about a break even. We're showing profitability on soybeans, corn, and sugar beets. This is without a JV cost, so own stock. Sunflowers are showing just a shallow loss. We're using FSA planting prices of 18. I know there's contracts out there for potentially higher than that. Barley at 450, just as a shallow loss. Edible beans, seed soybeans, and even old crop hay for producers are all showing profitability. So you can see that the 2021 outlook is a lot stronger than we were a year ago. And it's going to make an interesting debate as we continue into this spring. And I'm sure you'll have these conversations with your customers is, what crops, what crop rotation, what looks the most profitable, what is going to be the best for us agronomically. And those are some of the questions that we have with our farmers as well when we look at those kind of things. So thanks, everybody. I'm going to stop sharing and I'm going to turn it over to Randy.
Okay, thank you. We'll go ahead and get started. Thank you for allowing us to visit with you this morning. As you can see with Tjosaas's presentation, things for the 2021 year have changed to a certain degree with the markets rallying. And as we go forward, we'll take a look at maybe why some of these things have changed from some bearish markets going back to 2017 with the start of the trade war. And all of a sudden, it looks like we have a strong bull market. Just a little history down the road of where we've been. Since last August, let's say, that when things looked pretty bearish and with the pandemic, the outlook didn't look very good as far as farm income. So what are the events that occurred that changed this thing to more of a bull market? Of course, we had China's buying spree that started in August and has continued through today. And I don't know if that was honoring their phase one part of the trade agreement, or if they just needed to buy that much more product with their swine herd starting to rebuild, or if they just wanted to build reserves. We also had a number of things happen in the United States with some dry conditions in the Western Plains, which affected the Corn Belt and which provided a poor finish to what looked like could have been an excellent crop. In our areas, we had frost that came in early September that maybe took a little bit of top of the yield off. Also, a lot of our conditions from the previous year where we had a very wet harvest in 2018 and probably compacted some soils definitely affected our yields that we did get for the 2020 crop. Of course, the big windstorm in Iowa took about 250 to 350 million bushels off of the production from the US. So that was a big event that did lower the carryouts. China also had some flooding damages in many of their corn production areas, which helped feed this bull market. While this was all happening, the funds began to establish a large, long position in the commodity market. And when they do that, generally speaking, they will push the prices higher than maybe what the supply and demand scenarios may say. The 2019 marketing year came to an end on September 1st, and USDA came out with 250 million bushels less corn than expected from the 2019 crop. And that could have heavily been due to an underestimate of low test weight from that 2019 crop. And they also lowered 52 million bushels on the soybean side. So we had a drop off of available grain due to the 2019 crop, and then a lessening of the 2020 crop. which helped feed the bull market. Also, we had a very fast and dry soybean harvest in many areas of the country. With prices rallying, most people wanted to bring those beans to market, turn that to cash. A lot of people were sad because at this, if you look back today, they sold too early. But it looked like at that time that was the right thing to do. And many of those beans were moved to market. Acres on corn through this process came out to be 1 million less, so thus cutting production further from the 2020 crop. And soybean acres about 700,000 less than was expected earlier. A lot of that was some preventive plant calculations that came into play later in the growing season. Then to add to the feed, the dry conditions and slow planting of the soybean crop in Brazil and in Argentina also helped provide more feed for the bull market. That crop is being currently harvested now, which is later than normal. They're approximately in Brazil about 5% harvested, and they'd probably be 30% harvested, which has slowed down some of the export potential from South America, turning China to buy and fill some needs for soybeans currently. We also had some dry conditions in the western belt of the hard red winter wheat area, and there was some dry conditions in Russia, the Black Sea region, as well as Europe, which kept wheat in the game as well in this bull market. Also, along with everything going on in the pandemic, a lot of countries look to stockpile some grain for food security, and that could be a priority as we go forward in 2021 as well. Also, soybean barge was shipped out of the United States to Brazil, so that tells me that their ending stocks from their previous crops were very tight. Now, as harvest begins, of course, they will probably begin to use more of their own production to meet their needs before they export out to China. If we go back to the ending stocks on March 1st of 2020, USDA had us pegged at 3.3 billion bushels of carryover. And as of today, that crop is now at 1.5, so virtually cut it in half, thus showing us that the market is fairly bullish. Soybeans also were at 405 back in March on the early estimates, and now at 120 million. And we'll take a look at how that compares to some of the history that we've had. And the big questions will be, at what price do we start to ration beans? A big crop report yesterday. Trade expecting the corn numbers to fall farther from that 1.5 billion, and they didn't, and 20 million out of corn. So today's market, we're actually down 15 on corn and down 35 on beans, with some good volatility in the market. US-China phase one obligations, the expectation was that we would do about 34 billion of ag commodities to China. They did ramp up, of course, their sales, and the market reacted. They did get about 27 billion done through the year end. So that's, a number one big reason, I believe, why the market has rallied. So going forward into the 2020 crop year, with the markets rallying and the crop budgets looking better for 2021, what's our weather going to end up like in this growing season? The drought monitor is showing some dryness in the Western Plains, especially in North Dakota, South Dakota, Minnesota. And will that persist? That could be a big factor going into what may happen with the wheat market as we hit spring. The outlook for that through April looks like some of that could persist. So that's going to be a careful watch as we go forward in this marketing year. Also, the weather in South America as they begin to really ramp up harvest of soybeans in Brazil, and the Argentina crop getting off to a start. For the most part, they had very dry conditions in South America. On this slide, this is through February 1st. You can see that on a lot of areas, they were in that 30 to 50% of normal moisture, I think harvest is going to tell the story of exactly where we're at. They're projected to have a large crop at 133 million metric tons. We'll see if that follows through when we get some actual harvest data. Even with that large crop, with the U.S. crop at 120 million bushels, very tight stocks to use ratio, still provides some bullish sentiment to the market. Currently, they have been getting some rains, which has delayed harvest a bit in South America. So again, that's going to maybe push a few more soybean exports out of the U.S. as we go forward. So let's just take a look at each crop and and put together some kind of an outlook of what we should be looking for as we go into the 2020 year. Exports for the 2020 crop have been very good, and usage has been very strong through January. China also not only has bought 750 million bushels of corn, they've also added about 200 million gallons of ethanol for export, and as China builds those reserves. Also, with the soybean crop in South America, harvest being delayed, that means second crop corn that goes on that same ground means that planting is off to a later start, which could put that production cycle in a critical hotter time frame in April, May. 60% of that second crop safrinha corn is expected for a lot of that expected to be for export. Thus, that could provide some market implications April, May for the corn market, with the carryouts being at 1.5 billion. Also, we're looking for a potential acre battle in the U.S. Which crop provides the most profitability? And if you looked at Josh's information, corn and soybeans were profitable at this venture. One thing I will mention, though, is that the expense side of the budgets are changing every day. Fertilizer prices are going higher. So if people haven't locked down some of those costs, seed, fertilizer, chemical, it might be a good idea to visit with growers to do that and at least get that portion of the budget put together and locked in. Crop insurance has begun in February, which means we'll be setting crop insurance price. And it looks like if you take a look at a revenue protection policy, in most cases, corn and soybeans, I would say 85 to 90% of the costs would be covered with an insurance guarantee. Also, we'll have to watch spring and summer weather. Will that drought persist as we go forward? And then will the USDA, on the last bullet there, tighten the stocks even farther at 1.5? In yesterday's crop report, they did increase exports by 50 million. Some people believe with China's book and possible exports to Mexico and Japan that could have increased by about 150 to 200 million, thus lowering our ending stocks just a bit. If you take a look at a projection, which gets us down to a 1.2, that means the carryover into the next year's crop, estimating a 94 million acre planting in the US, which would be an increase of about 4 million acres, we could still be at a carryout from the 21 crop of about 1.5 billion bushels, thus providing some pretty good price supports through the 2021 growing season. Exports for corn have been strong, and generally speaking, the U.S. export program picks up once we hit February. Basically, the export program for the marketing year starts September 1. Usually soybeans win the game early, and then corn picks up once we hit February through April, May, and June. One thing I like to look at historically is some charts. And in a lot of cases, you don't have to go back too far to see where we've been or where we can look for some resistance in prices. In this case, in this year, with the carryouts being as small as they have been, if we take a look at, we're at about 8 to 10% carryouts, stocks to use ratio on corn. And if you have to go back to the we'll call it the 2013 crop year, where we were at 9.2% to get close to that same kind of number. So And in that year, in the corn market, we hit 518 for a high in May for December corn delivered at harvest. That's futures price now, but we can see that on the chart back in 2013. If you're putting together some kind of marketing plan, we've taken out the highs in the past 10 years. We're working on, currently we've had a 465. There's possible 473 back in 2019 and a 518 possibility from there. So those could be some possible targets. If you're talking with growers about marketing grain at profitable levels, those could be targets that they might be looking at for the upcoming growing season. One other thing on corn is that we've gone back to the 2008 crop year and looked at a chart, and in the black is the 2008 upfront month of May crop, and then also shows the red line, currently 2021 May contract, and we followed that fairly closely, and that shows that there's some potential maybe up to 620 on that chart. Yesterday's high, we did hit, I think, 572 off of the May contract. Soybean outlook, again, exports for soybeans very strong, along with usage October through January. Crush has been record almost for each month. October, December, and January. October, November, December, and then January numbers yet to come out. Harvest in Brazil is slow. We'll see again when harvest actually takes place. Do they hit that 133 million metric ton crop, which is record, as they've expanded acres each year? And we'll see what kind of quality that may provide the market with some of the moisture problems they're seeing at harvest. Also this year, again, the acre battle in corn and beans. The early projections are 94 on corn, 90 million of beans, which is an increase of about 10 million acres from the prior year. In 2020, we did have 10 million acres of prevented plant. And with prices the way they are today and the conditions we left the ground in last fall, it looks like those acres will get planted. The incentive to plant is there with the price. So we'll see how that acre battle fares out. Also, again, spring and summer weather is going to be a big part of that. Will we rally farther once we hit those summer months, or will the weather turn around and the drought conditions relieve? Stocks to use ratio probably going to drop down to less than 120. Which is a 2.6% stocks to use ratio. That is one of the lowest stocks to use ratio we've seen. USDA generally does not post a number under 100, which is kind of a pipeline number for soybeans that would be left in the US. Back in 2013, we did hit a 92 million carryout number, but that means that stocks are very, very tight. And at some point, the market may have to ration these beans off. Now, with yesterday's report and the market reacting lower today, that just provides more buying opportunity versus rationing soybeans off. So very low stocks to use ratio, possibility that we could go to 105 carry out by the end of the marketing year. Plug in a 90 million bushel bean crop, we're looking at a carryouts with a trend line yield of about 151 for the 2021 crop, which could provide that good pricing opportunity throughout this growing season. Also, if you look at exports on where we've been, if you go back to the beginning of the marketing year, soybeans have outpaced a year ago and outpaced the 5-year average as well. And as that starts to slow down, even at West Central Ag here, we took in about 13 million bushels of soybeans at harvest and through now, and basically all those have gone for export. We have about 200,000 left of that 13 million bushels. So most of those have shipped out to P&W. Also, if you look at long-term history, again, we have to go back to more of a long-term monthly chart. On the front month for November beans, we did put a 1203 high in. Yesterday, we tested about as close to that in recent times here at 1199. The next potential high could be something in that 1289 if you look at this chart. we're going to need to retest this 1203, then that 1209 as we go forward. Again, the corn and bean prices today are at profitable levels. And if you want to take some risk out, or recommend to the growers you work with to take some risk out, maybe get some pricing done on that end of it. And back in 2008, if we take the May soybean chart and look at where we're at, it pretty much has mimicked what we've done in 2008. And in that year, the high was like close to 1565. So that could be on an old crop kind of scenario. And new crop, you know, I think anything in that $12 zone, the guys should be looking at selling, if not some before. Wheat outlook, just a quick little look at wheat, and then we'll take a look at a little marketing plan and then wrap it up with some questions. But Russia put on an export tax. They're looking to hold more wheat in the country for food security. That would begin on February 15th, which could turn some exports to the US. Canada has been very strong on their exports in wheat. There were smaller crops in Russia, Ukraine, and Europe last year that took a little bit off the world supply of wheat. The weather in the hard red winter wheat belt also is definitely dry, and also this cold spell could provide some winter kill. If some of those fields look like they're in tough shape, some of those acres could be tore up and planted to soybeans with the soybean price that we have. Also, if you throw wheat into the acre battle, spring wheat yet to be planted, the early estimates are that we could lose about 750,000 acres of spring wheat compared to last year. So wheat may have a little bit of a play as we roll into April and May to try buy some more acres back. Also, if you go back to the drought map that we took a look at, the dry conditions in South Dakota, North Dakota, and Northwest Minnesota, if those would remain as we hit spring, there could definitely be some weather premium in that market. Also, the wheat stocks finally did drop under a billion bushels at 836. For many years, we've been hanging at that 1 billion bushel carryout, which is a burdensome 50% stocks to use ratio, now getting down into the 30s. If you look at a chart on a long-term look, and if we need to compare that somewhat to compete with acres for corn, corn at $4 cash, in my mind, 6 to a 1.7 ratio, we would need about 680 cash wheat. So if wheat wants to buy some acres to compete with corn, we're going to have to see wheat make a run a little bit more to the upside. So as we go forward,
excuse me, Randy, we should wrap this up in a minute or two. There are some questions we'd like to have those addressed.
We'll do that.
Thank you.
So one thing that I would say is that if you're putting together a marketing plan, maybe have some patience and sell in some smaller increments. Definitely profitable prices. Get your inputs locked in. I would consider locking in seed, fertilizer, chemical, fuel, and hopefully most growers have done that already. But that definitely would help them put a plan together to market the 2021 crop going forward and have a profitable year. So as always in my presentations, we ride the grain train, and the grain train is full of happy faces this year. So hopefully that means that it's going to be profitable for everyone. And with that, we'll open it up for questions.